Hi, welcome back to Elements in Focus. My name is Aaron Rheaume, the Director of Financial Planning, and I've got Grant Sullivan here with me today. Thank you so much for joining in. If this is your first time watching our Elements in Focus video, Grant and I and some of our other team members take a few minutes each week to break down our 5 critical elements, and those are your life after work, tax planning, investment playbook, risk management, life happens, and legacy planning. Today, Grant, we're going to talk about market volatility and the responses. So much of this is just behavioral. I'm not going to steal what you're going to talk about, but we do see a lot of different types of responses when market volatility hits, and it does happen, and it can happen sometimes without knowing. And how do we respond and react to that, Grant? I'm going to tee that up for you. What are we talking about here when we're looking at market volatility and just responses to it?
Absolutely, Aaron. I appreciate you setting me up for this. It's such an important conversation for us to have, folks. When we look at data for the individual investor, it screams unfortunate clarity. And that is this: the average market over time, the market has averaged a little over 9.5% with reinvested dividends since inception. And some of you may be shocked to hear this, but the average investor year over year, the same time period only averages less than 2%. Why is that? How could that be possible? Well, it's everything Aaron just brought up. It's that sometimes we see red on a screen or we listen to the news and our blood pressure raises, our heart beats a little faster, and we have to make a knee jerk response, right? And then things don't actually turn out the way we thought, or they were better, or they're a little worse, and we're kicking ourselves on the table. But folks, here's something to set us straight and maybe calm our nerves a little bit, and that is this: it's okay to do those things because we're human beings. We're emotional creatures, right? We're not robots. And so, does that mean, though, that our average return as an average investor should be under 2%? Absolutely not. So, what Aaron and I wanted to do today is actually arm you with some thoughts, some strategies on what to do, how to respond appropriately when market volatility actually does arrive. And there's three main areas, the three biggest ways you can protect yourself from making an emotional decision are: stick to your investment plan. And we've been harping on this for a long time. So those of you who are watching our content, you're probably rolling your eyes going, here Grant goes again about our investment plan. It's so important though. And here's what I mean: diversification. A plan that works in good times, as long as it meets a lot of criteria that we'll go through here in a minute, will also work in bad times. You have to understand your risk tolerance. You have to understand what you're trying to accomplish. And you build a plan around that. Build a structure, a vehicle that will get you through all times, no matter what. That means sometimes we'll miss the highs. But guess what? When the lows are low, sometimes you'll miss those too. And it depends on your investment outlook, your phase of finance, which, by the way, we have a great book on that too. You might want to check out from the website. And so, looking at everything that's available to you, diversification, right? Know your plan, diversify, have multiple investments in different investment categories because we never know who the true winners or losers will be. And diversification, folks, does not mean having money at different investment firms, right? We all have the same stuff. It's diversifying and investing totally in conjunction with the entire pie on things like foreign currency or foreign investments, fixed income, maybe non-growth oriented stocks, even though those have been performing very well for the last couple of years, right? And also regularly rebalance. So, case in point, last couple of years, market's been doing really well because of maybe 6 or 7 stocks, and they've gotten a little bloated. It may be time, even though it doesn't feel good because you're winning, right? You're winning the gamble, to re-diversify because they don't always go up forever. And then another point in here is stay in line with your goals. It's easy to get greedy and it's easy to get fearful. And so make sure your plan has been designed to help you face both. Okay? Because again, there's an old saying here in the Midwest: pigs get fat, hogs get slaughtered. And what that means is you never want to go above your skis, you never want to get too greedy because sometimes it can catch you off guard. Avoid emotional decisions, folks. This is the second piece. Don't panic sell and avoid trying to time the market. It doesn't work. If anyone in our industry could have figured out how to get the tops and avoid all the bottoms, folks, all of us would be investing with them, right? It's not a strategy anyone has been able to trademark. What we have found is over time, the most successful thing an individual can do is stick to what their risk tolerance tells them and build a plan successfully around their goals. That's the surest way to get the job done because it helps you to keep your perspective and prevents you from making emotional decisions. And the third big one is focus on what you can control. So none of us can control the stock market. I can't tell you what Microsoft is going to do or Nvidia or anybody else. But when the market does turn over, sometimes it can create good buying opportunities. So having enough assets built up in different places that you can redistribute for good buying opportunities is a great way to take advantage of market volatility. Also, increase your savings over time, right? Even today with the inflation being higher and goods getting more expensive, right? Sometimes it's hard to do so. We understand that. But one of the surest ways to fight market volatility is increase those savings periodically over time or consistently month by month or paycheck by paycheck to help you capture some of the falling market, right? 'Cause dollar cost averaging buys it up at a discount. And those are really sure ways to help us take advantage of some of you in the negative times. And finally, this is the biggest one, folks. Reassess your risk tolerance. Grant, what does that mean? That means take a look at who you are and what your tummy tells you on the amount of downside potential you can take. So if the market's up 40% and you're like, woohoo, right? I want that. Who doesn't? But the downside is that could also create a 60% potential option by investing that way. You have to ask yourself, is the risk worth reward? And most of the time when we are sitting down and truly evaluating who we are and our goals, that is not the case, right? In some places it can be, but most of the time, understanding what we're truly comfortable with losing actually helps put things back in perspective. So I hope those three areas are help point you in the right direction. And then Aaron, as we wrap up there, is there anything else you would add to this? Because it's such an important topic. And I hate watching families that walk in the door who've never been with us before say, hey, I lost all this money because I got emotional and things got crazy. I just need to be done. Is there anything else you'd add to this discussion?
Grant, I wouldn't add much other than, as you mentioned, most of this is behavioral, and people do not like to see their balances drop because they have such an emotional attachment to it. And one of the things that we walk people through here at FEG is making sure that they're aligned with their risk tolerance. And so we have a process that we walk people through. It is a lot more behavioral based. And so we'll show you what can happen in different market downturns. We can show you over the next 6 months, your current portfolio, how it's invested, what types of risk and reward. If you want to know, do you have that right risk alignment? Do I have the right diversification? Please reach out to us. Call us at 800-928-4001. Schedule your complimentary next steps meeting. You can scan the QR code. If you go to yourlifeafterwork.com, you can click on one of the advisor's pictures. It'll link us up for a 15-minute phone call to where we can answer questions. If you really truly want to know about your risk tolerance and see if you're maybe over diversified or under diversified or maybe taking on too much risk, go to yourlifeafterwork.com/chart your path. I'll say that one more time. yourlifeafterwork.com/chart your path. You can go and take our tolerance assessment, see if you have that correct alignment. If not, make sure you reach out to us. Again, 800-928-4001. Thank you so much for watching our videos. We hope you have a great day.